Ever felt like you need, I don't know, a secret decoder ring to understand a company's financial report?
Yeah.
You're looking at all these numbers, this really dense jargon, and you just want to know what's the story? What's actually going on?
Yeah. What does it mean for the company you care about? Right.
Yeah.
That's exactly why we do the deep dive. We sift through the filings, pull out those key insights, those aha moments for you.
Exactly. No more wading through pages of dense text. We try to deliver the important stuff directly.
And today, we're diving into a brand pretty much everyone knows, Ulta Beauty, Inc. The beauty superstore, right? They're a powerhouse.
For sure. And our source material. It's the recent Form 10Q filing from August 2025. Now, this isn't some dusty old document. It's a fresh look, a transparent snapshot of their financial health, how they operate, and honestly, where they're putting their money strategically.
It really is a great way to see how a, let's face it, technical document actually reveals the real dynamics of a major retailer. So whether you're maybe an investor or just curious about the beauty market, or maybe you just want to understand how a big company ticks financially.
This deep dive is kind of a shortcut. We want to make these, complex financial and legal details feel accessible, maybe even interesting.
Compelling, even. Let's see if we can manage that.
Okay, let's get into it then. So what's the big picture Ulta's painting in this report? Let's maybe start with that financial snapshot because it really tells a story of growth right off the bat.
Right. So Ulta Beauty, Inc., ticker Ulta on NASDAQ, they're what the SEC calls a large accelerated filer, basically a big established player. Their main office is in Bolingbrook, Illinois.
And they seem to be thriving. As of early August 2025, their total assets were over $6.6 billion. That's what? Up from about $6 billion the year before? That's significant growth in assets.
It absolutely is. And what's interesting, their net income for the first half of 2025 was almost $566 million, which is almost exactly the same as the first half of 2024.
Okay, so income's flat.
But, and this is the key part, their diluted net income per share actually went up to $12.49 from $11.78.
Ah, okay. So same profit overall, but each share is worth more in terms of earnings. Suggests maybe fewer shares out there. Good management.
Exactly. Fewer shares outstanding, likely due to buybacks, which we'll probably get to. It's definitely a positive sign for shareholders. Shows they're not just maintaining profit, but actively enhancing shareholder value. So yeah, these first numbers, they suggest Ulta's not just standing still. They're growing strategically.
Okay, that leads perfectly into strategy. Numbers like that don't just happen by magic. How are they driving this? Net sales for the quarter ending August 2nd jumped by over $236 million. That's a 9.3% increase, hitting $2.8 billion. Pretty strong.
Very strong. And it wasn't just luck. The filing points to three main things. First, strong comparable sales. Second, the acquisition of Space NK. And third, contributions from new store they've opened. It's a combination of factors.
Let's break down those comparable sales. A 6.7% increase there. The report says it was driven by both more transactions, up 3.7%.
Meaning more people actually shopping.
Right, and people spending a bit more each visit. The average ticket size was up 2.9%.
Yeah, and that's a really healthy sign for a retailer. Comp sales cover stores open more than a year, plus salon and e-commerce. Seeing growth in both traffic and basket size, that shows strong customer engagement. They're getting people in and getting them to buy.
But it's not all smooth sailing, is it? The report mentions, inflation and macroeconomic pressures impacting consumers. What are they worried about there?
Well, these are definitely headwinds. Management acknowledges it. Persistent inflation, general economic uncertainty. It could mean people pull back on spending. That could slow sales trends and squeeze profits, not just for Ulta, but for retail generally.
And inflation could keep interest rates high too, right? Which affects borrowing.
Exactly. It all ties together.
Okay, speaking of costs, let's quickly look at their structure. What actually goes into cost of sales for a company like Ulta? It's not just the makeup, I assume.
No, not at all. Obviously, there's the cost of the merchandise itself, though, that's offset somewhat by income they get from vendors. But then you've got big operational chunks. Distribution costs, that's labor, freight, warehouse rent, e-commerce shipping and handling, rent for the retail stores themselves, payroll for the salon staff, and inventory shrink. That's the industry term for lost or stolen goods.
Right. So opening new stores or even just shifting the mix of products they sell can move that cost of sales number quite a bit.
Definitely. And what's revealing is where Ulta says its main cash needs are. It basically maps out their growth plan. They're spending on rent, obviously, capital expenditures for new stores, remodels, relocations, building up merchandise inventory both for more stores and new brands.
Okay.
Plus supply chain improvements, share buybacks, which we mentioned, and investing in IT systems.
So it paints this picture of a company really pushing hard on growth, expanding stores, more products, better logistics, better tech. These aren't just keeping the lights on costs, they're strategic bets on grabbing more market share.
Even with those economic headwinds we talked about. And it's worth noting, their cash needs tend to peak between August and November. That's when they really load up on inventory for the holidays.
Makes sense. All right, let's shift focus a bit to the balance sheet, financial health, management decisions reflected there. Total current assets look strong, over $3 billion. dollars.
Yeah, very healthy. And you see their physical presence reflected too. Property and equipment, net of depreciation is about $1.33 billion. And then operating lease assets, basically the value of their rights to use leased properties at another $1.68 billion. Big retail footprint.
Okay, now here's a number that really made me pause. Goodwill. It went from like $11 million dollars to almost $400 million. dollars. That's a massive jump. What's that all about?
That's the Space NK acquisition showing up big time. Goodwill represents the premium paid over the fair value of the identifiable net assets. Think brand name, customer lists, market position, intangible stuff.
Ah, so it's the value beyond just the stores and inventory they bought.
Exactly. And the filing notes, this allocation is still preliminary. They have up to a year to finalize it, so that number could still change a bit.
Got it. And on the other side, liabilities. We see current operating lease liabilities, naturally, but also this pops out. Short-term debt of $289 million. That was zero a year ago. What's that telling us?
It tells us they've started drawing on their credit lines, a revolving credit facility, likely funding some of that inventory buildup and those growth investments we discussed. It means they're taking on some debt, which costs interest.
Is that a worry?
Well, the filing does offer some comfort. They ran a hypothetical scenario. If interest rates went up by 1%, it wouldn't have had a material impact on their operating income for the first half of the year. So it suggests they're managing that risk, at least currently.
Okay. Now, balance sheet numbers are one thing, but let's follow the money. Cash flow for the first 26 weeks of 2025. Where did the cash come from? Where did it go? Net cash from operations was solid, around $566 million, mostly from net income.
Right. But when you adjust for non-cash items like depreciation, you see some big movements.
Yep.
The most significant one, a cash outflow of over $366 million for merchandise inventories.
Wow, $366 million increase in inventory. That seems like a really big bet, especially heading into the holidays with potential economic worries. What are the risks and rewards there?
It's definitely a calculated risk. The danger is getting stuck with too much stock if sales soften, leading to discounting and lower margins. But the reward, having the products customers want when they want them, especially during the peak season. Not having stock means lost sales.
So they're basically betting on strong holiday demand, loading up now.
Pretty much, it's a classic retail strategy, using cash now to prepare for future sales. Aggressive, maybe, but potentially necessary.
And we mentioned Ulta returning value to shareholders,
Yeah.
share repurchases. Tell us about that program.
Yeah, they have an active program. In October 2024, they authorized a new plan for up to $3 billion in share buybacks, replacing an older one. As of August 2025, they still had about $2.2 billion left under that authorization.
And they're using it.
They are. In the last quarter alone, they bought back over 244,000 shares. It's a clear signal of confidence from management and, as we said, helps boost earnings per share by reducing the share count.
Okay, let's peel back another layer now. The financial plumbing, you might say. Ulta's loan agreements. They have the second amended and restated loan agreement, updated pretty recently, August 2025. Gives them access to $1 billion in revolving credit. That's their main line.
Yes, that $1 billion revolving facility is crucial. It gives them flexibility for working capital, investments, seasonal inventory swings. That short-term debt we saw, that's them drawing down on this facility.
Right. Let's tackle some of the jargon in these agreements. First up, borrowing base. What is that in plain English?
Okay, think of the borrowing base as the pool of high-quality collateral Ulta can borrow against. It's not all their assets. Lenders calculate it based on specific percentages of things like eligible credit card receivables, eligible accounts receivable, basically customer payments they're owed, and, importantly, eligible inventory.
Eligible being the key word.
Exactly. Lenders only want to count assets that are likely to be converted to cash. So for inventory, it can't be obsolete, damaged, stuff like that. For receivables, they generally need to be recent, not from affiliates, etc. It's a way for lenders to ensure the loan is backed by good liquid assets. The base value fluctuates.
Got it. So it's the value of the good stuff they can borrow against. Then there's this term, covenant trigger event. Sounds serious.
It can be. Think of it like a warning light on the dashboard. If Ulta's available borrowing capacity, the difference between their total credit line and what they've actually borrowed, sometimes called excess availability, drops below a certain level, say $100 million or 10% of the line cap, it triggers this event. It usually means more scrutiny from lenders, maybe more frequent reporting requirements. In some cases, it could even require them to pay down debt faster or lock up cash as extra collateral. It's a mechanism to protect the lenders if the company's financial cushion gets too thin.
Okay, that makes sense. And their share buybacks, we talked about how important they are. The loan agreement calls them restricted payments. Why that term?
Restricted payment is just a broad category in loan agreements that covers various ways a company sends cash out that doesn't directly operate the business. Think dividends, share repurchases, sometimes certain types of investments.
So they're restricted because the lenders put limits on them.
Precisely. There are usually payment conditions. Ulta can generally only make these restricted payments, like buying back stock, if they're not in default on the loan and they still have enough excess availability afterwards. Lenders want to make sure the company isn't prioritizing shareholders over its ability to repay debt.
Right, got to pay the bills first. One more key term. Material adverse effect, often shortened to MAE. What constitutes an MAE?
The MAE clause. It's a really important and often debated term in finance and law. Basically, it refers to something happening that has a significantly negative impact on the company's business, its financial condition, or its overall results, or, importantly, on its ability to actually perform its obligations under the agreement, like making payments.
So it's a catch-all for really bad news.
Sort of. It's intentionally broad. It sets a high bar, but it's a critical threshold. Hitting an MAE could trigger defaults or allow parties to back out of deals. It's meant to cover major, unforeseen negative events that fundamentally change the picture.
Okay, thanks for breaking those down. Moving beyond the loans, it's worth reminding ourselves that these financial statements aren't just math problems. Management has to make estimates, right?
Yeah.
Assumptions.
Absolutely. Critical point. Things like how much inventory is worth, what percentage of loyalty points will be redeemed, potential bad debts, future tax liabilities. These all involve judgment calls by management.
And those judgments could be wrong.
Well, the report explicitly says actual results could differ, maybe significantly, especially if the economy changes quickly. It's just the nature of accounting. It requires estimates based on the best information available at the time, but there's always uncertainty.
That preliminary allocation for the Space NK acquisition seems like a prime example. They said it's not finalized, the goodwill number might change.
Exactly. Purchase accounting is complex. Valuing all the acquired assets and liabilities takes time, sometimes up to a year. So the initial numbers are just that preliminary.
The report also details their stock-based compensation options, restricted stock units.
Right. A common way to incentivize employees and align their interests with shareholders. They detail the expense recognized in the period looks like over $20 million combined for different types of awards. And they also mention unrecognized expenses, which tells you about future compensation costs already baked into existing grants.
And just briefly, the filing even included details from an employee separation agreement, things like release of claims, non-compete clauses.
Yeah, it's interesting because it shows the breadth of information these filings contain. It gives a glimpse into the legal and HR side of the business, the kinds of agreements they have in place when employees leave, like non-competes lasting 24 months in this example. It illustrates the comprehensive nature of corporate operations captured in these documents.
Okay, so wrapping up here, the report, like all SEC filings, includes a section on risks and forward-looking statements. What's the key takeaway for you, the listener?
It's basically the company saying, look, we've made some statements about the future based on what we know now, but things could change. They list potential risks, maybe operating results decline, forcing them to write down assets or close stores. It's standard language, but important.
And they clearly state they don't have an obligation to update these forward-looking statements if things change later.
Correct. Which means the picture they provide is a snapshot in time. It's incredibly valuable, but it's based on current info and assumptions. It's not a guarantee of the future.
Okay, so let's try and tie this all together for you. We've dug into Ulta Beauty's recent 10Q. We've seen a company showing really strong sales growth, even with those economic pressures hanging around.
Yeah, and they're clearly investing heavily in new stores, the Space NK acquisition, building inventory. Plus, they're actively returning cash to shareholders through buybacks.
And we've peeked behind the curtain at the financial machinery, the credit lines, the borrowing base calculations, the covenants they operate under, how they manage cash flow. Hopefully, understanding this gives you a much richer view than just looking at sales or profit headlines.
It really connects the dots, doesn't it, between the Ulta store you might walk into and the complex financial and operational engine running underneath.
Absolutely. Which leads us to our final thought for you to consider. Ulta's making these big bets on growth, on acquisitions, on inventory in a pretty uncertain economic climate. How well positioned are these investments for potential shifts in consumer spending, especially in this evolving beauty and wellness market?
Right. And looking ahead, what metrics, maybe beyond just the usual sales and net income, might become even more crucial for judging their long-term health and resilience? Something to think about.